So I invest for dividends and cash flow. I invest for financial freedom. One day I will live off of the dividend income that my stock portfolio generates. And I've been doing this now for over 20 years. I've been investing for over 20 years, and I have a dividend stock portfolio that includes over 30 stocks. And I received this question, hey Ian, out of your 30 stocks, do you own any positions that pay dividends on a monthly basis? And the reason people have been asking this question is when one transitions from working a job to living off of dividends, it's nice to have a little bit of predictability. I just did a video on this. I'm going to link to it in the description below. And it's nice to have that predictability because when one works a job, the income is pretty predictable. It comes in usually twice per month, 2 paychecks per month. And so when one leaves a job and lives off of dividends, oftentimes it's nice to have that income come in on a regular basis so that it's easy to take the dividends and pay bills with them. And so the question is asked me, hey Ian, do you own any such stocks? And in fact, I do. I own a stock called Realty Income, ticker symbol O. This is a real estate investment trust, or REIT for short, and it's a stock in my portfolio. It's a medium-sized stock. Not a core position, not a small ancillary position, it's a medium position, and I like this company. I've been in it for a long time now, and today's video is all about my experience with this monthly dividend payer called Realty Income. Hey everyone, thanks so much for being here. Really appreciate it. My channel is growing quickly. It's a reflection of the vibrant community here on PPC Ian. Everyone is chiming in, sharing their insights. It's all about dividend investors, cash flow investors, supporting each other. And then that is just phenomenal. And so I love this question that came in about monthly dividend stocks. Just did another video on this topic of making income more fluid, dividend income more fluid. So this is technically part 2 of a series. If you want to see part 1, I'm going to link to it in the description below. But in part 1, we talked about a few strategies by which one leaving the workforce, becoming full-time financially free, living off of dividends, or even part-time, leaving the full-time workforce, becoming a part-time employee, and replicating half of their income or more from dividend stocks, how one can make that fluid, because as we all know, dividend payouts can be lumpy. Some companies, or most companies that pay dividends in the United States, it comes in on a quarterly basis. If you're investing internationally, it can be even more lumpy because oftentimes dividend payers will pay twice per year. And so this idea of making dividend income a little bit more regular, a little bit more fluid, maybe even monthly, is really compelling. And that's one of the reasons I have this stock in my portfolio. I really like this stock. And typically, when I'm evaluating stocks, I don't even look at the payout schedule. I look at fundamentals. But with this company, you cannot avoid the payout schedule because, in fact, they call themselves the monthly dividend company. If you go to their website, Realty Income website, ticker symbol O, they literally have, it appears that they have a registered trademark on the phrase, the monthly dividend company. And so you can't ignore it. And certainly it's not the main reason I bought the stock, but it's nice to know that I have this stock in my portfolio because it's nice to have a little bit of monthly income. If I ever need it, I need to tap into it right away. Right now, I'm actually reinvesting all of my dividends because I'm trying to build the snowball. I'm not living off of my passive income yet. But it's nice to build my machine, my portfolio in a way where it's going to serve my future needs perfectly. And I just know in my future, having that monthly stream of income, it's going to be nice. And so it's nice to have this one in my portfolio. And so I want to talk about Realty Income today. I want to start with this chart. I love this chart. I have a video on my YouTube channel that talks about how I often beat the S&P 500. It's the most controversial video on my channel. I get a lot of critical comments on it, sometimes negative, and I'm going to link to it below. And the fact of the matter is, most people criticizing that video, they say, hey, it's impossible to beat the S&P 500. Well, the fact of the matter, in most managed mutual funds, they can't beat the S&P 500. That is true, but most managed mutual funds, they have a fiduciary responsibility to diversify like crazy. They have to buy all these stocks. They have to be very diversified, and they can't do things that a smaller investor, individual investor like myself can do. If I wanted to, for example, I could put all my money in Realty Income. And look, this is just one example for my portfolio, but if you look at Realty Income versus the S&P 500, you look at a total return with all dividends reinvested, Since 1994, Realty Income is up 16.3% on an annualized basis. S&P 500 is coming in just below 10%. And so obviously, Realty Income is vastly outperforming the S&P 500. It's a stock I have in my portfolio, and so that portion of my portfolio that's been in Realty Income has outperformed the S&P 500. It's doing really well. I've been in it a while, and this is just one example. Now, why do these larger mutual funds have so much trouble beating the S&P 500? They can't put 100% of their money into Realty Income. And by the way, I don't do that. I own over 30 stocks, and I have a diversified portfolio. But most managed mutual funds, they can't even do that. They can't have 30 stocks. That's too few. And if you look at my 30 stocks, I'm going to do a video on this in the future. If you look at concentration, it's a subset of that 30 stocks that's so concentrated it makes up the vast majority of the portfolio. And so I'm going to do some, I know I've been getting some questions here about, Ian, how do you weight your portfolio? Small positions, medium, large. Ian, how much money, percentages do you put into small stocks, medium, large? I'm going to do a bunch of statistics on this. I'm going to share this in a future video. But basically, managed mutual funds could never do what I'm doing because it is not considered right. It is not considered right by the financial standards that are out there, the fiduciary standards. And because these mutual funds oftentimes have these handcuffs on in some cases, they just can't do what a more nimble investor like myself can do. They don't look at things the way I look at things, and therefore they oftentimes have trouble beating the S&P 500. Oftentimes not even to their own fault because it is so many rules in place that they can't do certain things. But I bet you there are investors, probably a lot of the people that work at this company, that put 100% of their money into Realty Income. And this company's actually been in existence before 94. It started trading publicly in 94. They've actually been in business since, I wrote this down here somewhere, quite a long time. Yeah, there, 1969. I love it. 1969. There were probably investors there was a private REIT, not publicly traded before then, that were invested in this company. But there are probably people at this company who just have this, and they've done just fine, and they've all beaten the S&P 500 over the long term. And so I don't want to belabor the point because quite frankly, the purpose of my channel is not necessarily beating the S&P 500. Maybe that's a nice ancillary benefit, and maybe it'll happen some of the time. Maybe it won't. Maybe going forward, it'll never happen. The fact of the matter is this channel is about developing passive income that one can live off of. But I just have to start with this because this is such a compelling chart. Go to their website. They have it there, easy for anyone to find. They've not only beaten the S&P 500, but the other major indexes as well, such as the NASDAQ as well. So really, really exciting and compelling. So one of the reasons I like Realty Income now in 2018 is the stock has come down. It's on sale right now. And why is it on sale? It's a real estate investment trust. Real estate investment trusts are favorites of income investors, people investing for income. And with bond yields starting to head up a little bit, it's got income investors thinking, well, should I put my money in the bonds or should I put my money in the real estate investment trust? It's often an either or investment. And oftentimes you saw this with Southern Company too. I just did a video on Southern Company. I'll link to it in the description below. Utilities and REITs right now are under pressure. They're under pressure because interest rates are going up, because investors will finally have alternatives for yield other than these types of stocks. Current yield I'm talking about, not long-term yield, but even right now the starting yield is over 5%. And so they will have other options, and because of that, it pressures these types of companies a bit. Also, these companies do have some debt. Realty Income is really good at managing its debt, but I checked it out. It's got some debt, and when they refinance their debt over time, they'll refinance it potentially at higher interest rates, and so that could squeeze them a little bit. It could affect them a little bit, but that said, I imagine as they renew their leases, they can push the higher interest rate cost along to their customers. And so just something to be aware of there. But needless to say, I have seen some real estate investment trusts and also utilities on sale right now. They're not my core focus in 2018. My core focus is Procter & Gamble and Kimberly-Clark. I've talked about that in my 2018 goals video. I'm going to talk about that. I'm going to link to it in the description below so you can learn more. So this isn't a core focus of mine, but I do plan on making some small purchases here in 2018 when I get a starting yield like this. I just can't pass it up. So what does Realty Income do? They are a real estate investment trust that owns over 5,000 properties. And they're diversified by geography. They're diversified. They're in most of the United States. They're diversified by industry. This is a company that pretty much pioneered this concept of triple net leases. What they do is they own properties in most of the United States, diversified across industries, and they'll go to a big company. They'll say like, hey, XYZ big box retailer, you carry this real estate on your book. You own this real estate. Why not let us buy it from you? Free up a bunch of cash that you can do to grow your business, and we're going to lease it back to you. And what's cool about these triple net leases is the company that is leasing the property from Realty Income, that company actually is going to pay not only the amount of money that's required to lease the property, that they're going to go ahead, they're going to pay real estate taxes, they're going to pay to insure the property, and they're going to pay for tenant improvements, all of the upgrades, upkeep of the property. So it's really hands-off for Realty Income. One of the challenges in real estate is real estate firms spend a lot of time with property management. And property management can be overwhelming at times. It can be a lot of work. It's very hands-on. But what Realty Income has done is they've taken a lot of the property management out of it. They place it back on the people who are leasing the properties. But it's a win-win because the people who sell the properties to Realty Income, they're freeing up so much cash that can be used to grow their business. They're very, very well diversified. And even if you go to their website, you look at which tenant makes up which percentage of revenue, there's no one tenant that makes up an overwhelming amount of revenue, which I really like. They're really diversified on that basis. And so it's really cool because they've generated a portfolio across the United States, mostly commercial in nature, but they've got retail too. And I would say what's great about this is they've got long-term leases. Their average lease, years left on a lease, I found this on their website, is 9.8 years. So they don't have to renegotiate these leases on average for another 9.8 years out. And so that creates a lot of stability for a company like this. They've been in the game forever. They really know what they're doing. So we talked about the results. The results have been really good. What else I like about these guys is they're really growing the fundamentals. When one analyzes a real estate investment trust, it's important to look at funds from operation. And so net income, earnings per share, those types of metrics for real estate investment trusts, they don't always add up. It doesn't make sense because net income is post depreciation. But in real estate, what oftentimes happens is these properties, they're worth a lot of money, but from a tax standpoint, from an accounting standpoint, they get depreciated on the books. And that messes with the net earnings per share, net income metrics. And so what funds from operation does is it takes the net income, it adds back in depreciation, amortization, and then it subtracts out any sales of property. And so when one is looking over time at real estate investment trusts like this, one of the metrics that's really unique to this industry is funds from operation. And the FFO, looking at them just the last 5 years, I looked at 2012 to 2016, they went from $2.06 per share to $2.88 per share. This is up 40%. This is up 40% in the last 5 years. That is fabulous. I love that. And so in a climate where the company is growing, the funds from operation are growing, but the stock is down because of this interest rate stuff, it creates, in my opinion, and again, just my humble opinion, somewhat of a buying opportunity because I'm locking in a starting yield at 5.37%. So this is also worth mentioning here. This is like Southern Company. This company doesn't grow the dividend that quickly. The combined performance is just great, but overall dividend growth, it's not as high as I like to see from some of my world-class blue chip brand name companies, which can get as high as 7%. Although in this market, it's been harder to find, more difficult to find 7% dividend growers. But anyways, they've been growing their dividend in recent years about 3.8% per year, which is pretty solid for a company like this, especially with a high starting yield. If I take the 3.8% year over year dividend increases, I compound it out for 10 years. 10 years from now, it is likely that my yield on cost will be 7.8%. Not going to be game changing, but still pretty darn nice, especially when the starting yield is so high. And yield on cost, by the way, for those that don't know, this is one of the fundamental metrics that I always look at in my dividend portfolio. It is basically the dividends that I'm receiving divided by my purchase price, not the current share price, but my purchase price. And so if I hold for 10 years, my purchase price is whatever it's trading at now. I'll take the yield, the dividends I'm getting in 10 years, divide by my purchase price. That's how I get yield on cost. And so it's the yield I'm receiving that on the amount I had to pay for the stock. So I love yield on cost. I think it's a great metric for dividend investors, for cash flow investors. And getting a yield on cost, 7.8% is pretty nice in 10 years. And I'm going to tell you why yield on cost is an exciting metric. Historically, over time, the S&P 500 has returned about 10% per year. If I can yield nearly 8% per year, I'm getting most of the return of the S&P 500 just in dividend yield. And that doesn't even count for the capital appreciation, which has been really strong on this stock, Realty Income. And so, in my opinion, this is a really, really unique and interesting stock. So anyways, one thing worth noting with a real estate investment trust is the taxes get passed along to the investors. So historically, the way these stocks have been taxed is the money coming in, it's not a qualified dividend. So it's actually treated as ordinary income. And this is a factor that's going to be really important for dividend investors. Qualified dividends that stock like Procter & Gamble would pay, it's taxed typically at long-term capital gains rate. However, a ordinary income dividend that comes in from Realty Income, it's going to be taxed as ordinary income, so it potentially a higher rate of taxation. And so that's something to just keep in mind. But needless to say, I like having real estate investment trusts in my portfolio because they provide diversification, they provide monthly income. There are very solid companies in that arena like Realty Income that I like. And at the end of the day, it helps me bring my current yield a little higher. So here's something interesting. I'm not going to retire for a while. I'm not going to be financially free for a while, but that's what my thought tells me right now. That's what my planning tells me right now. What if I need this income tomorrow? What if I need to change my life? What if I need to change things immediately? It's always nice to have a little current yield. So many of the stocks I own, the starting yield that I have right now, it's not very high, but 10 years from now, it'll be phenomenal. By contrast, starting yield here is pretty high. 10 years from now, it's going to be good, not phenomenal, but 7.8. Why do I like to mix in some of these stocks that have a higher starting yield? It creates a cushion. It creates some predictability. If I need to change things tomorrow, I have a portfolio in place right now that not only pays monthly dividends, but also has a very high starting yield. So literally shares I'm buying today, they start paying me cash immediately on a monthly basis that could really help me pay bills if I needed that money now. I don't need it right now, so I'm reinvesting it to snowball my income, snowball my dividend portfolio. But what if I did? We just don't know what's going to happen in life. And so having some current yield, a starting yield, a high yield, it's always an interesting thing. It's always a good thing for my dividend portfolio. So just a fun video today about Realty Income. I actually work in the real estate industry. I'm a real estate developer and investor. And so in my stock portfolio, I try to minimize my real estate investment trust exposure because I have exposure elsewhere. But the fact of the matter is I like this company, so I really wanted the exposure to Realty Income. I like the monthly dividends. I like the performance. I like the financials and the starting yield. And I quite frankly like their diversification. I would say a risk factor potentially with this company is that things are changing really quickly and there's a move from brick and mortar stores to e-commerce. And we've all seen that move. We've seen it happening before our eyes with disruption. I would say from my personal analysis of their portfolio, it is so well diversified by tenant, by industry, that I believe that they will weather the storm if there is any storm that comes their way really well. Also, what I like is their occupancy is really high. I don't remember the precise number, but I was looking on their website. Go to their website. It has a world of information. The portfolio occupancy right now, from what I remember, is around 98 or more %. So they're full. They have very low churn. They're very full on their portfolio, which is a great indicator. But we'll check that over time. 5 years from now, is it going to be 98%? Is it going to be lower? I don't know. I would say that could be a potential risk factor. And if there's one thing I'm watching with Realty Income, I go into all investments eyes wide open. It would be the occupancy of the portfolio. Is it going to stick up really high? And I would say the other thing eyes wide open are increasing interest rates going to affect them at all. We'll see how well they're able to pass any interest rate debt refinancing along to their clients, to their tenants through increased rents and increased rents in those leases that they have to renew. So monthly dividend company, I'm going to close on something here. I'm going to do a video on this. Actually, I already filmed it. I'm going to be presenting it shortly. I love companies that pay dividends because they care about the people that own the company, the shareholders. If you go to this company's website, the whole purpose of this company is to pay these predictable monthly dividends for investors like myself to live off of. And they are very shareholder friendly. Let's contrast that with a company that pays no dividend. A company that pays no dividend might have some cash sitting around. They may even spend that cash on things I don't want it spent on, even though I own the company. Maybe they have the best of intentions, but that cash, when cash is sitting around, somehow it finds a way to get spent. And so what I like about this company is they're very shareholder focused. They love the shareholders. They're in business to reward the shareholders. And this is how I tend to think about most of the dividend companies I own. I like to own companies that take the shareholders seriously because the shareholders own the company. And the shareholders ought to be rewarded as the company does well and it grows. Obviously, the employees should be rewarded too. The stakeholders, the customers, the partners should be rewarded. But the shareholders need to be remembered as well because after all, they're the ones that own the company. And that's what Realty Income is all about. So before I leave today, just full disclosure, I own Realty Income, ticker symbol O in my portfolio. I also own Southern Corporation, ticker symbol SO, Procter & Gamble, ticker symbol PG, and Kimberly-Clark, KMB. I am long on all of those stocks. I own those in my portfolio. Also, in terms of a disclaimer, this video is not investment advice. I'm not a licensed investment advisor. Today's video is just for your fun and entertainment. If you're going to go out and invest in the stock market or anywhere else, please consult a licensed financial advisor first. Hey everyone, if you made it this far, thank you. It's been a long video, but I wanted to make sure to cover this question. I've been asked this one many times. If you want to engage with me, please ask questions below in the comments. I answer most, if not all of them. If you want to reach me even quicker, head on over to my Instagram. I'm going to link to that in the description below. I'm actively checking it on my phone and I'm responding to questions. And so it's just one more way you can reach me. And before we leave, if you want to thank me for these videos, please do give me a like, a subscription, a comment. All of that means the world to me. Also, I just want to thank everyone out there. I'm getting a lot of community now. We're seeing a lot of community in the comments, and I'm seeing a lot of folks just answer questions, chime in, even share their personal stories. And you know, it takes a lot to share one's personal financial stories, especially not only the ups, but the downs as well. And look, I have had my fair share of both successes, but also challenges in investing. Everyone has who's been in it as long as me. Maybe not everyone talks about it, but I've been investing for over 20 years, especially in my early days. I made a bunch of mistakes. And so by sharing all of it in our community, we are only going to improve as dividend investors. We're only going to help each other out in our goal of achieving financial freedom and passive income, an abundance of passive income in our lives. So I thank you. I thank all of you who are part of that conversation. I will let you guys go. It's been a long video today. Thank you so much. I will see you in the next one.